Okay, welcome back. It's chapter 22, Statement of Cash Flows. So you've covered the Statement of Cash Flows in your introductory course as well in 315. We're only going to cover the direct method. In 315, you covered the indirect method. And you will only be responsible for the direct method for the final exam. So, in case you don't remember, there's three sections: operating, investing, and financing activities. These are the same for indirect and direct, but this is different. So, only the operating section will be new to you. The investing and financing sections will be the same. So, statement of cash flows is useful for the investor or the user to assess the liquidity and solvency, the amounts, timing, and uncertainty of future cash flows, and the reason net income and net cash flow from operating activities differ. So remember, in accounting, we use the accrual method. And the income statement and the balance sheet are both based on that. Statement of cash flows looks at just cash going in and out. So it's a completely different statement. It illustrates how cash and cash equivalents have changed over the year and why, accrual method, and turns it into cash-based. The date is a period of income statement. So for the year ended December 31st, 2020 or whatever. Three sections, as I mentioned above: operating and financing, that show the inflows and outflows, and that's the inflows and outflows of cash. Cash is defined as cash on hand and demand deposits. Cash equivalents are short investments that are readily convertible to known amounts of cash, insignificant risk of a change in value. So they're made up of non-equity investments that are acquired with short maturities, generally less than 3 months. Cash and cash equivalents also includes temporary bank overdrafts as a reduction in the total value. So when we say cash, in this context we mean cash and cash equivalents. Okay, so we're going to move right to part A, where we're going to talk about statement of cash flows. So, the direct method, which you haven't learned yet, is recommended by IFRS and ASPE. However, the large majority of companies use the indirect method. And it's probably because it's the same or the first method people learnt, or it used to be common in the past, so that's the one you learned, and everybody going forward just kept using that. However, you will see, although the direct method can be a little confusing to do, it makes more sense to the user. Now remember, investing and financing section statement of cash flows are the same regardless of which method is used. It's the operating section which is different. So under operating activities, basically all cash transactions from the income statement will be included and adjusted by changes in balance sheet items. The non-cash transactions will not be included, so you'll either just leave them off the statement or you'll have to subtract them. It all depends if they were already included in the expense balance. So on page 2 and 3 are the 6 categories that go into the operating activity section on a statement of cash flow using the direct method. So remember, with this, just I'll put a little title for us to remember, it's operating activities direct method. Okay, so basically we're taking the income statement, current assets, and current liabilities go in this section. So we're going to deal with all of those. Okay, so our 6 areas are cash receipts from customers, cash receipts from other revenue sources, so these are the receipts coming in, so these will both be positive. Then we're going to have 4 sections of payments. Now, not all of them will show up on all the questions, and it is possible to increase the number of sections. But generally, with this text and the examples, we're going to stay with these main 6. So, cash payments to suppliers. So that's going to be negative because cash is going out. Payments to and on behalf of employees. So that's negative. Cash payments from interest and dividends that belong in operating activities. And then on page 3, cash payments of income taxes. So those are basically the 6 areas we're going to look at in the operating activities section of the direct method. So basically what you have is a number of formulas, and we're going to record these formulas so that you've got a good reference point. And I'm just looking for a different pen. Okay, so cash receipts from customers. Basically what we're going to do is start with sales. So we're looking at how much cash did we get from our customers. So we're going to start with sales. And then we're going to add or subtract some things. So we're going to subtract AR if it increases, because remember we're trying to convert sales to cash. So if AR goes up, that means all these sales weren't on cash, some were on account, so we take away the part that's not cash. On the other hand, if AR goes down, that means not we make sales, but we collected on previous AR, which is more cash coming in. Okay? Now, make a little note to yourself. No AFDA is taken off. So we're going to treat AFDA separately. And the way we do that is AFDA over here, it's kind of made up of 2 pieces. So the change in AFDA is what we're interested in. And it's either going to come from customer write-offs or it's going to come from bad debts. Okay? So we're going to split this piece up. This is going to go in number 1. And the bad debts are going to go in number 3. So we'll have to minus any write-offs of AR. And that's how we're going to figure out how much cash we got from customers. So number 2, cash receipts from other revenue sources. So that's going to depend on what other revenue sources you have. Every question is going to be different. But you can think about things like rent revenue, interest revenue, dividend revenue, one note about dividend revenue, if they're using the equity method, check the investment account. Okay, so any other revenue? Excuse me, sorry about that. Any other revenue? And we have the unearned revenue category. So we're going to add increases in unearned revenue. Because if unearned revenue goes up, that means, remember it's a liability, we got cash, we debit cash, so we'd add that on. We would subtract a decrease in unearned revenue. Now, one other thing to keep in mind with this is if there's no other revenues, put with number 1. So if there's no other revenues, you don't do this all by itself, just move that up here. Okay, number 3. So these first two were both cash coming in. All the rest is cash going out. So the last 4 we're going to do is cash going out. So I'm going to list them as positive, but then at the end you put a negative on it when you've got your final number. So we're going to start with cost of goods sold, because it's cash payments to suppliers for goods and services. So accounts payable is related to that. If we have an increase in accounts payable, that means we didn't spend all the money on cost of goods sold. We put it on account. So we're going to take it away because we're trying to convert it to cash. We're going to add a decrease in accounts payable. Now, inventory is the one we have to deal with. Remember I said we're dealing with the income statement, all the current assets, and all the current liabilities. So, if inventory goes up, that means we bought more inventory than needed for cost of goods sold. So, did we have to shell out more money? Yes. Amount of cash, we're going to increase. If inventory goes down, we're going to subtract that amount, because that means some of the cost of goods sold came from inventory we already had from last period. So this one, we stockpiled inventory in excess of what we needed for sales. Now, I squished this in a little too much. The next thing we have to add is prepaid expenses. And if prepaid expenses go up, we're going to add them and subtract it if prepaid expenses go down. Because if they go up, it means we spent more cash besides just cost of goods sold, so we're going to add. Okay, then it's continued down here. We're going to add any other selling or admin expense. And subtract any non-cash expense that's included in other expenses or totals. So that's just going to go down there. Sorry, I should have left a little bit more room. So this one, start with cost of goods sold. Accounts payable affected. If it goes up, you subtract it, and vice versa. Inventory affects it. Prepaid expenses. Any other selling or admin expenses. And any non-cash expense that's included in other expenses or totals. So let's say we had total selling expenses. Part of that was depreciation. Well, is depreciation cash? No. So, for example, for this one, depreciation or bad debts. Okay? This is the biggest one. Now, you guys are lucky you don't have to memorize it, so you'll just have the formulas available to you, which is a lot easier. But you still have to understand it. Okay. Now, number 4 is cash payments to and on behalf of employees. So we're going to start with salaries expenses or wages expense. And then we're going to, if there's an increase in wages or salaries payable, we're going to subtract it because that means we didn't pay it all in cash. It went into a payable. Or if it goes down, we're going to add it. Then there's accrued liabilities that relate to employees. So subtract an increase for accrued liabilities and add a decrease in accrued liabilities. Then again, the catch-all category, because every company is different, plus or minus any other expenses or liabilities related to payroll and employees. So, for example, these might be CPP payable. So that would be here. So CPP payable, EI payable, etc. Things like that. And then if there's any other ones like healthcare payable, maybe that would go here. Or something like that. Okay, number 5 is cash payments of income taxes. Oh, I'm sorry. Interest and dividends that belong in operating activities. So if you remember from 315, sometimes the interest and dividends go into financing. It depends on what you do. But here we're interested in the operating activities. So we're going to start with interest expense. And then if interest payable goes up, we're going to subtract it. If it goes down, we're going to add it. We're going to add dividends on income statement only. So if you see dividends on the income statement that we paid out, it will go here. It's not though, okay? And related to this, we subtract increases in dividends payable and add decreases in dividends payable. But these are only for dividends on the income statement. Usually, dividends are in financing. It will tell you specifically if their dividends are on the income statement. Okay, so the last one on page 3 whoops, I seem to have lost page 3. Hang on. There we are. Is cash payment of income taxes. So, FIT is not cash-based, so don't include it. What we're going to have is current, and sometimes it doesn't say current, it just says income tax expense. And we've got the tax payable. We subtract an increase in CIT payable and add a decrease in CIT payable. And it's also called income tax payable. Okay, so that is the operating section. It's the rules for the 2 categories for cash coming in, the 4 for cash going out. So hopefully that made sense, and we'll talk about the investing and financing activities before we move on to doing some examples. Bye.